welcome to this video where we're going to talk about how to calculate a zero coupon bond. As you can imagine, a zero coupon bond is a bond with this many coupons. It's going to be issued at a discount. So always a discount.
Always issued at a discount.
Every single time. And it doesn't make sense to have a zero coupon bond that's issued at par. It makes no sense. All right, so let's get into this problem. Squat Cobbler Corporation issued 1 million face value. 1 million face value, that's going to be our FV right here, of 5-year zero coupon bonds. 5 years equals our number of periods. Zero coupon bonds equals our payment, PMT, payment. Dated January 1st, when the market interest rate is 6%. That's the market rate of interest. That's the required rate of interest for it. So that's the interest rate I over Y. And so this is a good chunk of our calculation. The last thing we need to do is let the calculator know how many periods are in a year. Periods per year is one period per year. And we have enough to actually figure out what the sales proceeds are. Well, guess what? That's the first question. What are the sales proceeds? What's the interest payment on the bonds? Well, it's a zero coupon bond, so we know the interest payment's zero. We need to find out what the sales proceeds are. And it's a zero coupon bond. It's always going to be issued at a discount. Always. So we know it's going to be less than $1 million. What amount of interest expense on the bonds would be reported in the following 2 years using the effective interest rate method? All right, that's basically how we've been calculating things in prior problems. And so we'll go through the first 2 periods of that. Usually I'll only require you to do the first 2 periods. And the reason why is because after you do the first 2, I already know you're going to do the rest. And if you get the first 2 wrong, there's no way for you to recover and get them right towards the end. You might know what the final payment is going to be, but everything in between that and the beginning will be all wrong. So usually I'll ask a question about the first period and second period to see if you know what you're doing. Determine the reported value of the bonds, which the carrying amount at December 31st, the following 2 years, assuming the effective interest rate method is used to amortize. All right, so that's basically the net balance of what the bonds are, right? What the net balance is on the balance sheet as a liability. And then 4, what amount of interest expense on the bonds would be reported under the straight line method of amortizing the discount? Well, the straight line method is pretty easy. You just take the amount of the discount and you just take it and evenly distributed over it. We're going to do that one also in this problem, just so you can see how the straight line method, it's an alternative method. You're not going to get a lot of questions on this. And the reason why is it's pretty easy. So we like to ask the questions that are used most in practice and that challenge you a bit more. Well, straight line is not used very often in practice. Usually the effective interest rate method is. So we have our calculator here. We got to clear this out. So clear time value, clear work, and make sure that we're at the end of the period, second BG end. All right, second quit. Let me just double check that. Boom. All right, so we put in $1 million.
$1 million.
Face value, 5 years, so 5 is the number of payments. Zero coupon, so 0 is the payment amount. And the interest rate per year, this I over Y is 6%, so 6 is the I over Y. And then we're going to compute present value, but we have to first make sure that this is on 1. Payments per year equals 1. If it's not, you press 1. Then you press enter, and then you press second quit. All right, we're all set. We'll go compute present value. And what we got was $747,258. So $747,258 is what the proceeds were for this bond. So that's what we're going to put in here, $747,258. $747,258. I always just double check to make sure I got the numbers right. All right, $747,258. That's the sales proceeds. All right, what amount of interest expense are the bonds will be reported in the following 2 years using the effective interest rate method? Well, let's go to that. This is our typical setup. We issued bonds, so we have liability. So we have a bond payable here. Bond payable of $1 million. I'm just going to put 1 million like that to save space. And then we also have cash, $747,258. We know that from the prior problem, $747,258. So cash is $747,258. Bonds payable is $1 million. And we have our discount on bonds payable as a debit. discount on bonds is going to be, it's going to be the net difference of that 1 million and the 747, which is 252, 742. Let's do the journal entry right here. This is the journal entry on issuance. We have a debit of cash of 747, 258. We also have another debit, discount bonds, and our discount on our bonds is going to be 252, 742. And then we're going to have a credit, and our credit is bonds payable, and our bond payable is going to be $1 million. So that's our entry on issuance. Okay, so that is 1/1. All right, so that's at the start of the year. Let's do the journal entry for 12/31, the end of year. So this is a zero coupon bond. So we don't have any cash that's going to be credited. There's going to be no cash that's credited. Nothing's coming out. Instead, we're going to have all of the credit is going to come out from our discount on bonds payable. And you want to keep a T account over here of your discount on bonds payable so you know what the balance is. So you know the running balance of your discount on bonds payable. This is 252, 742, right? 252, 742. That's our discount on bonds payable. It has a debit balance. And what we're going to do is we're going to end up taking a credit from that. And our debit is going to be the only debit and the only credit. The debit is going to be interest expense, and the credit is going to be discount on bonds payable. We have to figure out how much. Well, the way we calculate it is the net difference, that 1 million, net the balance, 252. So carrying amount at the end of the year is 1 million net 252, which is 747, 258 is that net difference between those two. And we have to take that times 0.06. Remember, 0.06 is that market rate, right? It was the market rate from the prior slide. Remember this market rate right here, the 6%, that's where we're getting it. So the 6% times the 747, 258 equals 44,835 interest expense. That's what our interest expense is going to be. So in this first payment period, right after they're issued, and recall, our income statement goes into our owner's equity. And so that interest expense right here is going to show up on our income statement, and it's going to be 44,835. And then we're also going to have our discount on bonds payable. And that discount is going to be 44,835. And this is what the journal entry will look like. 44,835, 44,835. And we got to make sure we keep track of it over here. 44,835. All right, so that's what we're going to write off. Now, if we take that and we subtract it from the 252,742 equals a total balance of 207,906. So the net carrying amount. So if you want the net carrying amount of what those bonds are, it's this amount subtracted from that 1 million, which is equal to, this is the carrying amount. So the bonds is going to be 79209 is the bond carrying value. Let's do the second payment. And the second payment is very similar to the first, but those of you that did not track or did not follow how we actually did this, this is where the rubber hits the road. This net carrying amount right here is what we have at the start of the period. So we actually have to take this bond value right here, this outstanding bond value, the 792,094, that's what we got interest on. So we have to take that 792,094 and we have to multiply that by 6%, market rate, which equals 47,525, and we could do 526, 5.6. So we'll round it up. So 47,526, and we'll put that over here as 47,526, 756 for our discount on bonds payable that we're going to journal entry. And then we got another discount. This is how it hits our liabilities. Discount on bonds. Ooh, not bonds, bonds payable, 47,526. And that's our interest expense. And if you notice something, the interest expense is increasing over time. And that kind of makes sense. The money that you take out in the first year is going to be the cheapest amount of interest. And the money that spreads over that fifth year is going to be the most costly because it's the furthest out in time. So if you look at how these entries are going, it starts at 44,835 and then it goes up to 47,526. That interest expense will be increasing over time because those dollars that are further out are more costly. Eventually, it'll amortize the complete amount off of the discount on bonds payable. So let's go ahead and get the net balance of these bonds for the end of that second year. So we have that 47,526, and we take that from our balance on our discount on bonds payable, the 207,906. We end up with 160,380. And that's our net balance of our discount. And if you want the bond value at the end, bond value, it's going to be net that 160,380 equals our bond value at the end of the second period. The bond liability is increasing. You'll notice that it's the net amount is 883,962. That's going to be the bond value at the end. Our journal entry is going to be interest expense and discount 47,526 and 47,526. And as you go down, eventually the discount on bonds payable will go completely off and be written completely off, and the bond payable will go out, and the final entry will be a cash entry of a cash payment of $1 million. And so let's go back to the prior questions. What amount of interest expense would the bond report in the following 2 years? Effective interest rate method. That's what we reported here and here, the interest expense in the following 2 years. We have that. Determine the reported value of the bonds, the carrying amount, December 31st, the following 2 years. Well, that is this amount, the 792,094. That's the bond value there. And this is the bond value at the end of the second period, second year. All right, so we're going to do second 1 and 2. And it is 839,620. That is the answer to that one. All right, what amount of interest expense would the bonds be reported under a straight line method of amortized discount? Well, what is the discount, the amortized discount that we have? What did we start off? We have that 747,258 that we had as the sales proceeds, right? If we take $1 million net that, we get a total balance of 252, and this is written on the other page, but we just want to make sure, 252,742, all right? 252,742. And what you do under the straight line method, and you guys are all going to love this, and you love it because it's easy, but this is just not the way we normally do it. It's not encouraged by either the IFRS or US GAAP, but you can do it this way. It's not often done that way. You just take that amount and divide it by the number of periods, which is 5, and the interest expense for every period evenly over the 5 years will be the 50,548 will be that interest expense every year, and it will be a flat amount. It won't be like this where it shows the fact that the interest expense is going to be lower in the initial years and higher in the following years. In this one, it just basically says straight line, it's discounted. Let's take the amortization of the discount over the life of it and bring it forward. That's how you do a straight line method amortization of a discount. Just super easy. Don't expect to get a lot of these because it's super easy to do a straight line method of amortization. You want to learn the effective interest rate method because this is the more complicated way to do it and the more likely way you're going to see challenging problems that you're going to be wondering how to do. Thank you very much. See you in the next video.
What's a squat cobbler?
Squat cobbler. You know what squat cobbler is.
No, I don't know what a squat cobbler is.
No, me neither. What is it?